Gold has been pirate treasure, currency, ornament, hedge, and a political football. With spot prices surging the past few years to new highs, helped by a softer dollar, global jitters and fears, and heavy central bank buying, gold has re-entered the conversation in a way that even skeptics have had to acknowledge. It's been one of 2025's strongest major assets, appreciating greater than 50%, making this the perfect moment to step back and ask, what gold is actually doing in a portfolio, and what has it done across centuries that keeps bringing investors back to it?
You do see periods like this where gold will do nothing for a decade, like between 2010 and 2020, and then kind of get up and go. It is interesting, given the past couple of years, gold actually has outperformed the S&P 500 this century, believe it or not. But I wouldn't count on that. I wouldn't count on that happening. But the recent demand for gold is driven largely by central banks. And that also makes it interesting as a diversifier, because the demand for gold and the price of gold is not related to either stocks or bonds. And that's what makes it interesting to have in a portfolio. It has zero correlation. The upside of gold is it's in high demand, and because it is this kind of part of the international banking financial plumbing, most of it is actually owned by central banks, and there's also a demand for it worldwide as a store of value. And so it's been a traditional store of value since the early 1970s. The compounded annual growth rate of gold against the dollar has been about 7%. Over thousands of years, people say, you can always use an ounce of gold to buy a really nice suit. And that suit's been getting a lot nicer recently, but that's why people say it's a really good store of value, particularly over very long periods of time.
Welcome to Catching Up to FI, a podcast on mindset, money, and life for late starters of any age on their journey to financial independence. I'm Bill, and I'm a late starter.
I'm Jackie, and I'm also a late starter, and we're your host. We're here to help you on your journey to financial independence, no matter where you're starting.
We're going to talk to experts, other late starters, and explore topics related to our mission.
Join us as we catch up to FI together.
Hello, and welcome back to Catching Up to FI. It's been a busy 2 months because Jackie and I have been traveling all over the world. We've actually only recorded together one podcast in September and October, and now we're back. The dynamic duo is back to continue the show together. Today, Jackie, we're going to focus on a really fun topic. The gold rush is on.
I love gold!
And the media is out there about it. It's had a remarkable run this year, and there's a lot going on. So our audience may not think that gold applies to them, but we want to throw it out there as a topic. We want to understand it and why it's happening today. You just sold a gold bar, right, Jackie?
I did. The process is ongoing with Alloy, which is one of our new partners, and I'm so excited. I actually went to the FedEx place to put it in the mail yesterday, and I'm going to keep everybody posted on how that's going. But you know what? It was just cluttering up. I did not need it. So, hey, if gold is at an all-time high, what better time?
I mean, this is the end of the year. It's time to declutter. Unfortunately, my mother-in-law just passed away, and there's a bunch of jewelry that she had, and my wife has inherited that. So it's an option for us. You don't have to go to pawn shops or the seedy side of town. There's an easy way to do this. You've heard the promo, and consider it if you want to make that gold money that you can invest and watch it grow as opposed to sitting in your drawer or in your safe. So think about the Alloy market when you have jewelry to declutter. All right, Jackie, we have Frank Vasquez back with us, and we want our guests to promote their charities. And Frank is a board member, the treasurer of the Father McKenna Center. And Frank, tell us about what this is about so our audience can understand and support that mission.
The Father McKenna Center is a small charity that supports hungry and homeless people in Washington, D.C., and we are associated with the Gonzaga High School, and we run out of the church basement there. We have about 1,000 volunteers that work at the center every year and about 8 full-time staff, and we do the very simple and obvious work of running a food pantry and then serving a lot of meals. We also have a hypothermia program coming up where we actually take in a small number of men during the cold season. And so we've been working on this for many years, and we'll work on this many years to come. Father McKenna himself passed away in the 1980s. He was a street priest. He basically walked around and took money from craps games and gave it away to widows and things like that. So it's a very active charity that hands out food. And we've had a lot of demand, obviously, with the government shutdown and everything. So everything that you can give would be great. My listeners are very generous and have given a lot, but I always need more donors. And so if you'd like to donate to the center, just go to the Father McKenna website and there's a donation page. And we take all kinds of donations, including appreciated stock. I actually gave them appreciated gold ETF shares this year.
Well, that was big.
Didn't have to pay taxes on those. Or QCDs or your donor advised fund. All of those things are available. We are a 501c3 charity. If you do give, please mention Catching Up to Fi or Risk Parity Radio in the little note that you can put in there so we can duly credit the Catching Up to Fi podcast or the Risk Parity Radio podcast, because we do like to see where our donors are from.
Yeah, you ran a top of the t-shirt campaign this year, and Risk Parity was at the top. We're running a bottom of the t-shirt campaign because we may not be the big donor, but I'd love to see our audience in this giving time of year, Giving Tuesday, when you're thinking about charities that you want to support. This is a great one. And we always want to support charity, and giving may come first for a lot of us because it's an important part of the FI journey and gratitude and abundance. All right. You've heard Frank a couple times on the show, but before we do his introduction, Jackie has a review that she wants to read.
Yeah, I do. And Frank, we totally love your charity. And right now, like you said, it is something that is badly needed. So speaking of gold, we have a gold review, actually a 5-star review from Apple Podcasts. It reads, I really enjoy listening to Jackie and Bill discuss financial independence. Both have a lot of humility and aren't afraid to showcase their past mistakes in order to help others. This is truly a show for us slightly older people who want to leverage money in order to build a more fulfilling life. Thank you too. And that is from Away Goals Matter. That is beautiful. And thank you so much. If you want to leave a review, just go to Apple Podcasts, or you can always comment on our YouTubes. We love getting reviews. It helps others find the show. So keep them coming.
All right. Yeah, that's great. This is why we do it. We want to help those starfish out there. That there's a great parable called the starfish story. Look it up, because you don't have to make a big difference. You can make a difference for one person, and your review helps somebody else will find the show, and it'll make a difference for them, we hope. All right, Frank, welcome back to Catching Up to Fi, where we like to unravel the maze of financial independence for late starters and occasionally discover the detours that are more interesting than the main road or simple path. And today is a bit of a detour. Today, we're sitting down again with someone who never wants another job and has a knack for making even the most tangled concepts in life and investing feel approachable. Frank Vasquez, the voice behind Risk Parity Radio. If you know Uncle Frank, as he's known in our community, where he helps you with your questions and answers to those, he brings an unusual Socratic method toolkit and a notable Foghorn laugh to the table. He studied economics and engineering at Caltech, then naturally rounded things out with a law degree, of course, from Georgetown. After more than 30 years as an international arbitrage attorney, cross-examining notable financial experts, and managing his own investments, he first wandered into the financial independence community dazed and confused and in need of a good haircut around 2009. He retired in 2020 at 55 and launched Risk Parity Radio, where among many other things, he translates seemingly complex portfolio theory into something more mere mortals and DIY investors like Mindy Jensen and Scott Trench from the Bigger Pockets Money podcast. So this is becoming a topic of interest in the community. And you can use this approach without hiring a team of quants or sacrificing your weekend to a spreadsheet.
That's right, Bill. And Frank has become one of the FI community's OG easy chair philosophers and one of the clearest voices on evidence-based portfolio design, alternative assets, and how different pieces of a portfolio behave in concert when the market weathers changes. And yes, he does it with that signature raw humor that makes even a discussion of covariance matrices feel like a gentle roast of the financial services industry.
Which brings us to today's topic. The historical evolution of gold as an asset in portfolio construction. Gold has been pirate treasure, currency, ornament, hedge, and a political football. With spot prices surging the past few years to new highs, helped by a softer dollar, global jitters and fears, and heavy central bank buying, gold has re-entered the conversation in a way that even skeptics have had to acknowledge. It's been one of 2025's strongest major assets, appreciating greater than 50%, making this the perfect moment to step back and ask, what gold is actually doing in a portfolio, and what has it done across centuries that keeps bringing investors back to it?
Yeah, and that's where Frank comes in. He has a gift for cutting through the mythology or methodology. I would have thrown it in slam. And getting to what the data and history actually show. He spent years studying how assets behave together, not just in isolation. So when we talk about gold's role, how it dances and occasionally stomps in a risk-balanced portfolio, Frank is exactly the person you want in the conversation.
So settle in, gold members, as we explore that shiny metal's long, strange, and surprisingly useful journey with Mr. Goldfinger himself, Mr. Frank Vasquez.
I always wanted to be in a James Bond film.
Good night, Mr.
Frank Vasquez.
Do you expect me to talk? No, Mr.
Frank Vasquez.
I expect you to die.
All right, Frank. This is a big topic. It's a niche topic, or so we think, but there's a media hype about it. We got to be careful with that. And in order to understand today's interest in gold as an asset class in our modern economy, and maybe its recent performance, we must first dive into its economic history. So, Frank, can we jump in to my hot tub time machine?
Don't be scared, Minnie.
And have you take us back to 4000 BCE and bring us up to the present and future of gold?
I suppose I will try to be brief, at least till the first 4,000 years or so. Obviously, gold was used by ancient people, mostly for sarcophagi and things like that in ancient Egypt. They didn't get around to inventing money until more closer to biblical times, with the Lydians were the first ones to use gold and silver. They had something called electrum, which was a combination of the two, until they started using it as coins. And then money was a technology that spread all through the ancient lands. And then most societies, large societies, started relying on gold and silver in particular as their monetary standards. And as time went on and we got to more modern times, the past few hundred years, gold had traditionally been the foundational money of just about every large society on earth, whether it was Great Britain or China or anywhere else. Where would you like me to go next?
Well, I mean, we should probably start with the 1820s because things changed through the last 2 centuries. And a lot of currencies were pegged to gold. And we had gold reserves maintained by governments to ensure currency stability. But that kind of changed as we moved into the 2000 or 1900s. With about 1933, I think something happened there in the U.S.
Yeah, that's right. The United States officially went back on the gold standard in 1873 with some legislation, and had pegged then the dollar to gold. I think it was about $20 an ounce at the time. In 1933, in the middle of the Great Depression, part of the way that all the countries in the world were getting out of their depressions was by devaluing their money. And since all their money was valued in gold, the United States also devalued its money and went from $20 an ounce to $35 an ounce. But at the same time, placed restrictions on the ownership of physical gold. So you could not own gold in the United States after that. And that was to prevent people from doing all kinds of things and essentially moving the gold out of the country and those sorts of things. In the United States, you weren't allowed to own gold as a private citizen until the 1970s again. And so modern use of gold as an investment dates only to the 1970s in the United States. Although that's not true in the rest of the world. In the rest of the world, gold has been a traditional asset that everybody's held. Anybody with money would hold some of their wealth in gold, and that's still true today. That's why there's lots of vaults in Switzerland and places like that.
And then so in the late 20th century, in the 1980s and 2000s, what happened with gold then?
There was another devaluation in 1971 in the United States. Thanks to Richard Nixon and the Federal Reserve at that time, we went completely off of the gold standard. It was still possible prior to 1971 for countries to exchange their currencies for gold under the Bretton Woods system. And all of the currencies were all pegged to gold, the major currencies at that time. In 1971, we went completely off that. All the currencies started to float, all the major currencies around the world, and nobody could any longer exchange dollars for gold from the U.S. Treasury. And so that created a demand for gold, or a devaluation of the dollar is a better way to express it, that instead of $35 an ounce where it was pegged, it began to go up in value. And there was kind of a frenzy towards the end of the 1970s, and it got as high as $800 an ounce and then dropped significantly after that, because that was also when Paul Volcker raised interest rates and basically brought down inflation. It was all part of that era. But that was the first era that you could own and trade gold in the United States in a generation. After that, it just became an asset that you could own, but it was very inconvenient to own it because you had to physically own it. And that's not a convenient way to hold gold or any precious metal.
You mentioned physical gold. Tell us about how the ETFs evolved that, and then let's maybe compare and contrast the physical ownership of gold with the modern way of holding gold in ETFs.
Okay. Yeah. So essentially, my parents' time and when I was a child, people would own things like Krugerrands were the first gold coin you could own. That was like a little ounce of gold. Those are from South Africa. After it became popular, the Canadian Mint started making their own gold coins. The United States Mint made their own gold coins. Australia did. And so that was the way that people who wanted to invest in gold would buy these gold coins, essentially by the ounce, and store them somewhere. And that was one of the big issues, is two things. You're going to have a big price differential if you're buying and selling physical gold on the bid and ask. It's going to be 10, 20% of the value of it, usually. And then you have a storage problem. You need to put it somewhere. And if you put it in your house, then you have a potential crime problem. It was not ever a very useful asset for individuals to own or use it as an investment. The only people that really could use it as investment were still banks. And gold still is a major banking asset around the world. It's what they call tier one capital. And so banks can hold that as real money. And actually, most of the demand for gold comes from banks around the world.
I only had like a 2.5 gram of gold in my house, and I was afraid of that. I mean, that's crazy to try to keep gold in your house.
You should not do that. That's very dangerous. Usually the people that steal it are your relatives, but your no good cousin is the one that finds out you have it and sneaks it out one day.
So with that physical gold, one of the biggest issues is storage. And if you don't store it in your house,
you have to pay somebody to store it. And there are a lot of, I wouldn't say institutions, but companies that specialize in that and will be happy to charge you storage fees. Everything for a fee. Everything can be had for a fee.
Yeah. So we've evolved from there, right? We've evolved.
Well, assets, David Stein breaks them down into, is it an investment? Is it a speculation or a gamble? What category does gold fall into, really? We talk about it as an asset. And is it an investment or a speculation?
It's a speculation because it does not have a cash flow coming from it. So it's like raw land or something like that. The difference between a speculation and a gamble, though, is a speculation is something that has a positive expectation in terms of you expect it to be worth more in the future. Whereas a gamble, and it's funny you mentioned David Stein, he just had a podcast today about sports gambling and was explaining the difference between sports gambling is gambling, whereas something like gold is a speculation. And it's important to know the difference between those two things because a gamble has a negative expectation. You expect to lose money going into it.
Okay. And there's also tax considerations with regards to gold. It's a little bit different tax structure. How does that look?
Briefly, I should caveat that every time I explain this orally, I get part of it wrong. But it is taxed as a collectible typically. And so instead of you getting the regular long-term capital gains tax rate, it is taxed at your ordinary income rate. So if you're in the 22% bracket and you sell it that year, you're going to be taxed 22% on that gain. So it's like a short-term asset, but it gets capped at 28%. So if you're in the top tax bracket in the 35 or whatever it is these days, you're only going to pay 28% on the capital gains from gold. Since it does not generate an income, though, the only time you get taxed on it is when you actually sell it.
So, Frank, talking gold as an investment, I want to ask you a few questions around how available this is for people that are in the accumulation mode. So most people start investing through their 401k, and that's a big chunk of their retirement or their nest egg. So do we typically see any type of gold mutual funds or ETFs in a 401k or other employer-sponsored plans?
You'll probably not see them in employer-sponsored plans because they generally have a limited selection of mutual funds. If you have a plan that allows you for a self-directed option, which a lot of them do now, in which case you can like open a separate account that's kind of like your own IRA, you can buy gold ETFs in there. You can buy gold ETFs in any IRA that you set up or any brokerage account. It's just like any other ETF. It's just like buying VTI or BND or something like that.
Yeah, and you know that new law that just got passed that said that you could have alternative investments inside your 401k, like I guess hedge funds or whatever. And I'm wondering, now that that law has passed, does that open the door to maybe more employers offering alternatives like gold?
Possibly. I think that's probably included. I'm not intimately familiar with the law. It was mostly to try to get private equity in there.
Yeah, that's what they're trying to do, private equity.
The large financial services industry has other interests because they see all that money coming into 401ks. There are things that they would like to put in there. They're not that trumped up on getting lots of gold because they're not going to make any money off of that. They want to have their private equity products and their other fancy bank products and things like that. Is what they're really interested in. And then the crypto people want to have their stuff.
That's the same thing that came to mind. So for people in the accumulation mode, like a lot of our audience, late starters, does gold have a place, and how should they be thinking about gold as part of their portfolio? Is it necessary for somebody at that stage?
No, it probably isn't useful for somebody who's in accumulation because it's used in a retirement portfolio as a diversifying asset. So it's used kind of like bonds, but you're not expecting it to grow as much as stocks. Historically, since it's been tradable, it has grown at, I think, it's about a 7%. If you think of stocks as growing at about 10%, the compounded annual growth rate of gold has been about 7% since the 1970s, and bonds are like 4%. So despite how it's performed in the past couple of years, you wouldn't expect it over a couple of decades to outperform stocks. You would expect it to perform better than bonds, essentially.
Right. So we've got a little recency bias going on because part of the reason why we're talking about this is that gold is at all-time highs. I see the commercials. Our audience probably sees the commercials, buy gold, these gold companies, and it gets kind of confusing. So we can always count on you to kind of clarify, like, where does that even fit into all of this for the average person?
I am so excited to announce our new partnership at Catching Up to Fi with Monarch. Monarch is a comprehensive financial tool to monitor your financial health and life. I have been using Monarch for 3 years to track my spending, net worth, budget, savings goals, and more. I am not a spreadsheet nerd, and without Monarch's robust, intuitive tools and user interface, this process would have seemed impossible. I was recently also able to seamlessly share my data with our new flat fee financial planner for a retirement readiness checkup when I turned 60. He uses Monarch with all of his clients. After our analysis, I was shocked to find out that we were financially independent 3 years before I thought we would be. You can't manage what you don't measure. Using Monarch was critical in this review and planning process and remains important in monitoring my ongoing financial health. Thanks to Monarch, all of our podcast listeners and community members have access to a 50% discount off their first year subscription. Simply follow the link below and use the discount code CatchingUp50 at checkout. I am proud to say that my sons are the first to use the code to join the Monarch family. I encourage you to share this link and code with family and friends this holiday season who need or want to take back their money and grow their wealth. I cannot think of a better, more generous or valuable gift or resolution. Happy holidays from all of us at Catching Up to Fi. Using your retrospective crystal ball now, in the last 2 years we've seen, is this because of fear and currency issues? Why has gold leapt like this into the media attention and gone up 50%? That's like unheard of in the history of gold. Why has that happened?
Well, it's not unheard of. For in the first decade of the year of this century, gold also went from a few $100s and I think went up 5 times that value or whatever it was at the time. So it does happen. It does have its day in the sun to shine, if you will. What is driving price these days is largely, as I said, this is an international asset. And a lot of the central banks now around the world are buying a lot of gold, including China, including Russia, including every central bank. That puts a demand for gold, and then also people see the central banks buying gold and they want to get in on it, and so it kind of snowballs. And you do see periods like this where gold will do nothing for a decade, like between 2010 and 2020, and then kind of get up and go. It is interesting, given the past couple of years, gold actually has outperformed the S&P 500 this century, believe it or not. But I wouldn't count on that. I wouldn't count on that happening. But the recent demand for gold is driven largely by central banks. And that also makes it interesting as a diversifier because the demand for gold and the price of gold is not related to either stocks or bonds. And that's what makes it interesting to have in a portfolio. It has a zero correlation. So frequently you'll see it going up in value much differently than stocks or bonds in a given year.
I mean, it seems like trust in the U.S. Treasury and the currency has driven money potentially out of the U.S. and into gold. Isn't it normally fear-driven as an inflation hedge? I mean, is fear what's driving this up?
There are too many people with their own explanations for this. Another explanation that is being given is this is kind of like the 1970s, and we don't know what the Fed is going to do, and they're going to be loose like Arthur Burns and Nixon were back in the early 70s, and therefore we should go buy gold. I don't know if that story is the right story either, Bill, but that's another one of the popular ones out there right now. The truth is, I don't know anybody that really is good at predicting when gold is going to go up or not. That's been a fool's errand, even worse than trying to predict the stock market or interest rates. So there are many different drivers of demand for it, but which one is the one today or combination of them, I don't know. I try not to speculate on that.
You can't invoke Sonia in your crystal ball. And if you listen to Frank's podcast, he plays these clips. And he hates crystal balls, and he has this great clip about Sonia. So look for it there.
So anytime somebody's asking me, well, why is this asset doing this thing now? It's like, well, if I knew, I'd be like expert trader and be really super wealthy in a very short period of time. But that's beyond my pay grade, and you're much better off just owning an allocation to whatever you're owning, whether it's stocks, bonds, or gold, and sticking with it and just rebalancing. That's the way to go, not to try and guess when the price of something's going to go up or down.
I mean, our audience, they know about diversifier in an asset class, but typically for them, it's like, okay, U.S., international, and maybe bonds as diversifiers and alternatives you don't see in accumulator portfolios for justifiable reasons, possibly, and simplicity potentially being one of them. But what does correlation mean, and how is that important with regards to asset allocation?
Okay, correlation is just a measure of whether assets tend to go up or down together or not. So if assets are positively correlated, say like U.S. stocks and international stocks, they're positively correlated. If one of them's going up, the other one's probably going up too, like 90+% of the time. Whereas something like bonds will have close to zero, depending on what kind of bond it is. It could have close to zero correlation. It could have a positive correlation, or in a depression, it could have a negative correlation, in which case bonds will go up when stocks are going down. The last time you saw that was in 2020 when we were in the middle of a pandemic, and then you saw it in 2008, 2001. Anytime there's a recession, you'll see that with bonds. With gold, it has a zero correlation to both stocks and bonds, which is important because it's not either a stock or a bond. So it gives you another thing that is moving differently. And if you have multiple assets in a portfolio that are moving differently, that's the basic principle of diversification. It will lower the overall volatility of the portfolio without lowering the returns as much. That's why they say diversification is a free lunch. And so when you're constructing a portfolio, particularly in retirement, when you're taking money out of it, you really want to focus on diversification.
Yeah, and we mentioned several times that gold is at an all-time high. So just to give us a little bit of a place marker, we're having this conversation in the middle of November 2025, and the S&P 500 is up roughly about 15% over the last year. Gold, contrastly, is up about 61%. Now, certainly we don't advocate for chasing returns or anything like that, but some people will try to do that. But that's where we are right now. So talk about returns, just having the diversification can be helpful, especially, like you said, if they're in the de-accumulation mode.
Yeah, it's like holding it now is like having a bonus on top of your stock returns. Holding it in the early 2000s was like having a lifesaver because, as we know, between 2000 and 2010, the stock market didn't go anywhere. It crashed twice. Meantime, if you held some gold and some bonds and some other things, you didn't suffer that much. Instead of having a portfolio that went down 40 or 50%, your portfolio only went down maybe 20% in 2008. And so that's the example or measure of diversification. One thing that is it's almost unique in the past decade to 15 years is that the stock market's been up almost every year, and there hasn't been a real serious recession or anything like that, just some minor blips. It's times like this when everybody's feeling good. It's like, what do I need diversification for? I like my stocks. I'll just ride that. That will come to an end at some point, and I don't know when, but there's never been a time when we didn't have recessions.
Yeah, I mean, it's interesting because there seems to be fear and greed operating at the same time in this market.
That's generally true.
Everybody's a little jumpy, but at the same time, they're like, yeah, let's ride this wave. It only goes up.
It's FOMO, Bill, because it's like, well, if I'm not in all these tech stocks or the Mag 7 or whatever, people feel like they're missing out. It's like, well, my portfolio only went up 10%. It didn't go up 25%. It's like, well, maybe 10% is good enough if it's not going to go down 50% at some point.
Yeah, that's where I'm at, edging in. I'm 60 now. I'm getting ready to have my 60-year-old colonoscopy in a couple days.
Good Lord, Austin. What sort of things do you keep in here?
Anything that catches my fancy, you know? Give it a good tug.
Oh, yuck.
I had my second one, Bill.
Oh, behave. Yeah.
All right, guys, let's get back to gold. How about that?
So I'm edging into retirement, and I'm like, I can't afford a 50% drawdown. And I'm believing more in diversification, uncorrelated assets, and I want smaller and shorter drawdowns, which is the attraction of a more diversified portfolio, risk parity being one of them. And people can get falsely reassured by being in the S&P 500, all growth, plus maybe international, and small or no bonds. But there's a lot of correlation there, and then the whole thing will drop if we get a crash like 2001 or 2008. So people need to be potentially, as they're edging toward retirement, a little more cautious. Maybe our late starters in particular, because for me at 60, wanting to transition into pre-retirement at 63 and then be full-time retired by 65, I can't tolerate a 50% drawdown for 3 or 5 years. I'll be working longer, right, Frank?
Yeah, that's usually what happens, Bill.
Bill kind of exaggerates a 50% drawdown for 3 years. Like, when in history has that happened? Maybe once, right? But the feeling is real, right? People, it's kind of like loss aversion, right? We hurt more when we lose something than we get excited when we're winning or when we gain something.
But if you were holding something like the NASDAQ in the first decade of this century, you would have experienced 2 greater than 50% drawdowns in 1 decade. And some people are holding things like that.
Yeah, for what period of time? That's always the question as well. For 3 years, maybe, but probably less likely.
Yeah, well, 3 years is 2001 to 2003. That's, if there's another .com crash, that's what you get out of that.
Right. And I'm not saying that it can happen. I'm just saying, what are the historical benchmarks and references?
Historically, stocks are up about 70% of the time. They're down about 30% of the time. And about 15% of those times, they're down because it's a recession. And that's where you get the biggest drawdowns, is in a recession. Now, something like 2022 was not a recession. That was an unusual circumstance. That was more of an inflationary spike. But that can happen. That's part of the other 15% of the time that stocks are down.
Yeah, and there's something to be said for, to your point, Bill, if you've won the game, why keep playing? So if you've retired and you've put in a 4, 5, or 6% rate of return because you have this diversification, then you're fine. So you just kind of have to look at your portfolio. What are your assumptions? And make sure that however you've set up your portfolio, that it makes sense for the assumptions that you chose.
Yeah, for you. And we're just talking about an option. Now, let's circle back to gold, and let's use the ETF, for example, GLDM, which is a traditional way, a cheaper way, and an easy way to invest in gold. Now, David Stein has 10 questions that he likes to look at for every asset, decide if it's an investment for you. Do you mind going through those with us, Frank? We're specifically talking about GLDM, which is an ETF where you actually do own gold and it's in the bank. You don't need to take physical acceptance of it. And then if we can't explain an investment like this ETF GLDM and haven't read the prospectus, for example, then we shouldn't invest in it. And that's one of his points.
If you're talking about the form of the investment, then you should distinguish the investment from the form of the investment. The form of the investment is an exchange-traded fund. And exchange-traded funds have been around since the 1990s. The first one was called SPY. And you should think of exchange-traded funds, ETFs, as a financial technology. Everything you invest in is really a financial technology. The stock shares are financial technology. Bonds were financial technology. Mutual funds were financial technology. That has been evolving over time. ETFs are a more modern version of a mutual fund, essentially. It's like an iPhone instead of a BlackBerry. And so they're more efficient, and they can be used to now hold just about any kind of asset, whether it's stocks, bonds, gold, some kind of options trading strategy. There are sort of an infinite variety of ETFs now. Gold is a relatively simple thing to put in an ETF, because the ETF provider just buys the gold, puts it in a vault, and then creates the shares and issues them, as opposed to, say, buying the shares of stock or buying the real estate and issuing shares on that. So that's how an ETF is created, and that's the modern way we should all be using. We should all be using essentially the equivalent of an iPhone, an ETF, and not a BlackBerry, and not a fax machine. A fax machine would be like physical shares of stocks, physical bonds, physical gold. That's 20th century technology. You don't want to use that anymore because it's inefficient and expensive. A fund like GLDM has a expense ratio of 0.1, I believe, today, which is one of the cheapest ones. And so that's why it's one of the most popular ones. There are probably about 10 different gold ETFs, but GLDM is a good standard one that is widely held by retail investors.
Yeah, and we've talked about, is it investment, speculation, or gambling? And this is a speculation because it has no cash flow, say dividends. And that's a filter for segmenting the investment universe. What is the upside of ruling gold, or a rule of thumb for estimating its investment returns?
Yeah, well, the upside of gold is it's in high demand. And because it is this kind of part of the international banking financial plumbing, most of it is actually owned by central banks. And there's also a demand for it worldwide as a store of value. And so it's been a traditional store of value since the early 1970s. The compounded annual growth rate of gold against the dollar has been about 7%. Over thousands of years, people say you can always use an ounce of gold to buy a really nice suit. And that suit's been getting a lot nicer recently, but that's why people say it's a really good store of value, particularly over very long periods of time.
Yeah, for example, it was what, $20 an ounce back in 1971?
It was pegged at 35 when it came off the peg.
And what is the spot price today?
About 4,200.
Wow.
Yeah. So that's not nothing over however many years that is, 30, 50 years, 55 years.
Yeah, but it's volatile. It goes up sometimes and it goes down sometimes, which is why you want to limit the amount you hold, but we'll get to that.
Okay, so Jackie, question number 4. What's that one?
All right, that is what influences its value, which Frank kind of talked about a little bit, but why don't you take us through that real quick, Frank? What influences the value of gold?
Yeah, well, it's scarce. There's only a limited amount of it. People can mine it, but that costs money. And so there's a lot more mining going on today because it's worth a lot more, but there's only a limited amount of gold in the world. And a lot of the gold in the world is not extractable. It's in the ocean, for example. So the demand for it comes largely from central banks. It's a scarce asset that's used as a store of value and also as tier one capital is what they say. Banks can hold it as tier one capital to shore up their balance sheet. And so they do.
And then David Stein wants to know, what is the downside of owning gold?
Well, the downside is it's volatile. You don't know when it's going to go up or down in price. It's unpredictable on that score. And I mean, that's about it.
Okay. Who's on the other side of the trade when you buy GLDM?
It could be anybody these days. If you buy GLDM, you're buying it on an exchange. So it could be another private party. It's typically transacted by banks, hedge funds, large institutions are traditionally the ones that buy and sell a lot of gold, particularly in ETF form. And it's become more popular among smaller investors in the past probably 20 years since we had ETFs, really.
Yeah, I mean, we didn't have access to it in, say, the 70s, 80s until the early 90s. And then Ray Dalio of Bridgewater in these hedge funds, they're the ones that brought this online and the whole risk parity concept and using gold in these portfolios. And so basically now the individual investor has access to strategies that using ETFs that weren't available to us without this technology, correct?
That's correct. Like I was saying, it's a financial technology that now we have cheap access to things that we didn't have access to, at least when I was a child.
As far as how much gold you should own if you do decide to put it in your portfolio. Now, I know you have some of these portfolios on your website, but generally for someone that's trying to get a proper allocation of gold, how much do you think it should represent? Just a range.
Yeah, so Karsten Jeske did a study going back 100 years. It's on the Early Retirement Now website. It's his Safe Withdrawal Rate series number 34. And basically found that if you add 10 to 15% in gold to any kind of stock bond portfolio, it's going to have a positive effect on the safe withdrawal rate and basically reduce the volatility of the portfolio. So there's no study I know of that definitively says that's the right amount, but that seems to be a good amount that if it's like less than 5%, it's probably not going to do anything. 10 to 15 seems to be a sweet spot. Of course, now that gold's going up a lot, other people are saying, well, maybe it should be 20 or 25. People get excited about that. If you're in a different country, larger holdings are more like between 20 and 30%, but they don't have the reserve currency in the world. And so that's also part of why people outside the US hold gold, because it's sort of like, would I rather have dollars or would I rather have gold? And they probably have some of each. Whereas most people in the US are like, well, I can just go with dollars. It's the reserve currency.
Yeah, I mean, I had a conversation recently with Bill Bengen, and we've been very fortunate to have him on the show, and he's a dear friend. And then he has come out with a book where he talks about the 4.7% withdrawal, and he believes now it could be even above 5. And he uses a more diversified research portfolio of 5 different stock assets and then bonds. And his old portfolio back from the 90s research was just the S&P 500 and intermediate term bonds. And so in using the new technology, he's like, yeah, diversification makes an impact on your safe withdrawal rate and your ability to spend more in retirement, which is really the whole goal, at the same time engaging in less risk. And he said he hasn't done the research study on it yet. He hasn't had that sort of class that he's put on his website. But he said, yeah, I think it could really benefit the safe withdrawal rate of portfolio. So that's coming online, and look for his research to come out, incorporating that into one of his other research portfolios.
What he's basically going to find is if you take his, I think he's got 35 or 40% in bonds in a portfolio like that. If you just swap out 10 or 15% of that and put it in gold, it'll raise the safe withdrawal rate of that portfolio by between 0.3 and 0.5 probably.
Yeah. I mean, so this is something to research. And one of the ways to research this is to listen to you on Risk Parity. And there's other ways too. I would encourage our audience to not stop with their curiosity as technology evolves and use maybe 20 or 30-year-old technology to develop your portfolios. I mean, current day takes a little while, a decade or two, to catch up to the new technology. You're potentially on the more experimental leading edge, but you have data and back testing to prove this. For example, tell us a bit about some of those sites where people can back test their portfolios to understand how it compares to, say, the traditional 60-40 portfolio, and look at their allocation and say, okay, this is justified based on base rates and back testing and not necessarily on forward projections or Monte Carlo theory.
There are several sites where you could test gold allocations. One would be Portfolio Charts. I'm giving you the free ones. Portfolio Charts is a good one. Portfolio Visualizer is another one. And you can do Monte Carlos there. You can also download the Safe Withdrawal Rate Toolbox from Early Retirement Now that allows you to put gold in portfolios. And now there's a new site called Testfolio, testful.io, that is also free. And you can do a lot of testing of portfolios there, not just gold, but any ticker you have or any portfolio you have.
And then rather than just guess, we should probably use data to construct our portfolios from sort of a rational perspective. And I didn't know about this stuff. You based it on Bengen's research, and that's not necessarily a guess. He's proven it. But with the way to look at sort of adding assets, and then in your risk parity portfolios, it's not like it becomes really complicated. People focus on maybe the simplicity principle first, and it's like, okay, let me just own the whole world in accumulation, and I don't need to think about it anymore. And then let me just do 2 or 3 funds and drawdown, and that's good enough because potentially I've oversaved as an earlier accumulator, and I can tolerate 30 to 50% drawdowns because maybe underspending and maybe I've oversaved. So the volatility above my FI line, so to speak, doesn't really affect me or shouldn't because I'm good, right?
Yeah, that's always a way to solve the retirement conundrum is don't spend much money. If your withdrawal rates are under 3%, yeah, you can hold just about anything you want. You could just hold 100% stocks or Warren Buffett's 90-10 portfolio. But the reason it works is because you're just not spending that much money. So even if you have a 50% drawdown, you'll be fine. But you won't get to spend as much money is the issue there. And if you want to accumulate the most by the time you die, yeah, that's the way to go is keep your stock allocations high and keep your spending very low, and that will accomplish that. I'm on the side of I want to spend more money now. So if you want to do that, then you have to have portfolios that are more diversified and look more like what Bill Bengen recommends or what I talk about on my podcast.
Yeah. What about the really hard question? When to buy and when to sell? That's the hard, tricky one.
I mean, this should all be written down as a plan. And typically, what most of us should be doing, as opposed to trying to guess it at that based on crystal balls or other factors, is come up with an allocation in your portfolio that I'm going to hold this amount of GLDM and I'm going to hold this amount of VTI and I'm going to hold this amount of maybe some of those assets that Bill Bengen's talking about. But so this one will be 25% and this one will be 10% and this one will be 15%. They add to 100. Then you should rebalance them like once a year. And your plan should look like that. You're not ever having to make a decision. You're just looking at your plan and following your plan. What rebalancing forces you to do is you sell high and buy low. So in our portfolio, I've been selling gold for 3 or 4 years now because it keeps going up. So when it keeps going up, we keep selling bits of it and either using that money to live on or buying other things that are low. So you end up selling high and buying low when you rebalance. If you're going to self-manage, that should be part of your plan so you're not guessing at that.
Yeah, and your investment policy statement, follow that always.
Yes, that's exactly what I'm talking about.
All right, Jackie, you have a story to tell. You checked out our sponsor, the Alloy Market, with a little gold bar that you sold them. How did that work out for you?
That's right, Bill. The short answer is it worked out great. I was really kind of surprised at how seamless the process was. I just ordered the kit online. They had it to me within days. I put the gold in the package, mailed it out, and almost instantly they notified me it was on the way. They told me when they received it, and they finally gave me a quote. And do you know how much I got for it?
No, Jackie, how much did you get?
Well, I got $285. And you know where that's going. That is going in my new grandbaby's 529 plan. And I was, again, very surprised at how seamless the process was.
All right, that's thealloymarket.com. You can declutter this season with your gold, silver, and platinum. Where do we go, Jackie?
Yeah, and here's a bonus. If what you send in is worth more than $199, you will get a $15 bonus. Just enter the code CUTOFI15 and get your bonus.
Let's take a step back to sort of a 10,000-foot view to understand your basic approach that I believe in too. You have 3 principles and maybe a 4th that we'll talk about. And we've gone through gold and stuff, but the order of application of these principles is important. Can you take us through those and give us a brief reason why you do it in this order?
Okay, yeah, these are the sort of the principles I use for constructing a retirement portfolio. The first one is called the Holy Grail principle, which means focus on diversification. And by diversification, we mean uncorrelated assets measured by actual correlation numbers that you've got out of some calculator or something you put them in. So you're not just looking at names of things and saying, oh, this sounds like it's different from that. That's different, and diversification are 2 different things. Things can be different and not be diversified. The Holy Grail principle says is that the more uncorrelated assets you have, the more you're going to get this diversification bonus and basically have lower volatility for the same amount of return. You've heard of the efficient frontier. It's a variation of that. That's all we're talking about here. It goes back to Harry Markowitz. The second principle is called the macro allocation principle. And all that says is that the sort of the big percentages tell you a lot about how your portfolio is going to perform. This actually comes from Jack Bogle's Common Sense Investing book. If you go to the back of the book, chapters 18 and 19, basically he found that all 60-40 portfolios kind of acted the same over a long period of time in terms of return. That's true of all 70-30 portfolios. If you have more than 2 assets, maybe you have 50-30-20 portfolios. Just deciding how much in stocks in your portfolio is a big decision point and an important decision point. Bill Bengen goes into that in terms of safe withdrawal rates, saying that it looks like portfolios that have somewhere between 40-something% in stocks and 70-something% in stocks have the best safe withdrawal rates. So if you're looking at retirement portfolios, you probably want to have your stock allocations somewhere in that range. If you're higher than that or lower than that, you're going to have a lower projected safe withdrawal rate. And so that's an application of the macro allocation principle. And then the simplicity principle, I use Einstein's definition for this, which is make things as simple as possible, but no simpler. So in this context, it would be, if I'm going to invest in gold, what's the simplest way for me to do that? The simplest way for me to do that is to go buy an ETF. It's not to go out and be doing physical gold or buying gold miners or doing something more complicated. If I can use a simple fund that's relatively inexpensive, that's what I'm going to do. If I'm going to own real estate and I don't really care about managing it, I'm going to buy a REIT. I'm not going to go buy a bunch of different properties. So the limitation on the simplicity principle is it's not the goal to have the simplest thing possible as your number one goal. Your number one goal should be a financial goal or a life goal, that you're either trying to grow your portfolio the most or have the highest safe withdrawal rate or something in between. The simplicity principle idea is make it as simple as possible, but no simpler.
Okay, so I think in majority of the FI community, they focus on the simplicity principle first. And they may take their 1, 2, or 3 fund accumulation portfolio and tweak it a little bit, but then carry it into retirement, which is a completely different phase of life where you're interested in wealth preservation and spending the most. Now, people think that what you do is complicated, but you argue that it's not. And you add these uncorrelated alternatives and different types of bond ETFs than, say, the typical VTS, AX, and BND and chill for good reason. I mean, how complicated is it really?
It's not that complicated. If you can handle 3 funds, you could probably handle 10 funds. You probably don't want 10 funds. How about 6 or 5 or something like that? The truth is, once people start constructing a portfolio, I tell them, you really only need 5 or 6. And they're like, but I want a couple more. That was Mindy Jensen when we built her Risk Parity style portfolio. It was like, okay, well, you can have them. But as long as you have a plan, and like we were talking about that investor policy statement where you say, okay, these are my allocations for these 3 funds, 5 funds, 10 funds, whatever they are. And I'm going to stick with these and then I'm going to rebalance them. It's really not that complicated once it's set up, because you can either take your withdrawals once a year, you can take them once a month, you can vary that. And that's going to be the same for any portfolio. What's odd about this topic is that people will say that having 6 funds is too complicated. But then on the other side, they're saying, but I'm going to have this bond ladder, I'm going to have these 3 buckets, and I'm going to have this other thing, and I'm going to have this. And that is complicated. So the idea that having just a few more funds is complicated, it's not as nearly as complicated as what goes on in most people's portfolios. It is more complicated than having 2 funds. But typically people that are having 2 or 3 funds, their real strategy is to keep their withdrawals low, because that always works. And so if you have an accumulation portfolio and you are committed to underspending it, you'll be fine. But if you want to spend more, you need a more diversified portfolio.
Yeah, and what you're talking about, honestly, is in the financial services industry, among a lot of retirement-oriented financial advisors, they'll have a bond ladder from anywhere from 5 to 8 years. For an income or paycheck portfolio, they might have 5% in cash, which is what you recommend, or no more than 10%. And people will say, oh, I'll need this cash bucket, I'll need this bond bucket, and then I'll have my growth portfolio, and they time segment it into those things. And like you said, that is complicated.
Well, then your investor policy statement then starts getting pages long once you have all of those different features, because you have to have rules for all of those. When does money move from this place to this other place? And when does it come out? How does it come out? If you just have a portfolio and you have some rules for withdrawal and rebalancing, it's not as complicated.
And then I think you recommend in your philosophy, and this is your philosophy, and this is a retirement drawdown philosophy, typically you recommend no more than 5 to 10% cash if people are going to hold cash, and they may not need to. And then you have sort of your 10 to 15% gold. There's an asset you talk about which is complicated to understand, but once you understand it, it's probably okay, and that's managed futures. We won't throw it out there.
That's a different podcast, Bill.
Yeah.
A whole different one.
And then you talk about maybe 20% in ETFs. And this is when we'll come into a bond conversation, which people don't talk about now because the stocks are up and up for 15 years. And there's a lot of aversion to bonds. I think Jackie has an aversion to bonds, but there's a place for it potentially in a retirement portfolio. And you'll recommend maybe 10 to 20% of actually long-term treasuries or intermediate-term treasuries because of correlation issues that we talked about. And then you have sort of the 40 to 70% stocks. I mean, it's not that complicated. You'll have stocks, bond ETFs, and a couple of alternatives. And as you say, you can do it in 5 or 6 funds. And then as I understand it, all you do every month is take, oh, this has performed really well this month, I'll take from that. And then every month you're taking from the best performing asset. And if you don't need it, you add it to the least performing asset. It does seem relatively simple.
Yeah, and let me just say this. So it depends on where you are with your investment knowledge. Okay, I could tell you flat out for a lot of people, it does sound complex. But once you start building your knowledge, as we try to do on this podcast, and making sense of everything, it may not be. But you guys are very savvy. You talk a lot about asset allocation. You do a lot of digging into it. But the average person, they barely know what a mutual fund is or an ETF. So it can seem overwhelming, more complex than just having 2 index funds. And I've learned plenty of asset classes. I don't think it's super hard, but I know that people are at different phases of their investment knowledge. Now, I have gone back to definitely the simple principle, and I do stock and some kind of fixed income. And I'm not a big fan of bonds, but bonds is only one kind of fixed income. So I'm not averse to fixed income because I'm retired. So I've definitely had to dig into this. I need to have something that I can take out that's not in the stock market. So I just don't prefer bonds to be that fixed income or that money that I need to pull off of.
Well, that comes back to one of Frank's other principles, and we're not trying to overwhelm you. We're just trying to
yeah, let's
you
settle. Yeah, let's not do that. Let's not do that.
Because everybody's individual, and it starts with your goals, it starts with your investor policy statement, and then you look at, okay, what's the math? How do I get there? What CAGR or compound annual growth of return do I need to get to my financial goals where I'm free? And then how do I preserve that? I mean, start with your goals first, your dreams, how you want to live your life, and then work out the math by back testing these things and saying, okay, this gets me there. But let's come back to the Bruce Lee principle, which I like, because this is what it fundamentally is about in the end. Yeah, I have my way. Jackie has her way. We disagree. That's okay. You're going to have your own way that makes you comfortable. But the point I think Frank makes, and I'd like to encourage, is investment knowledge, financial literacy is a curiosity, learning, growth process. I started from zero. I didn't know what a net worth statement was at age 50. I didn't know what a budget was. I was paycheck to paycheck, and I've remained curious. I mean, you can let your curiosity stop and you get to a comfortable point, but you know what? There's other options out there. There's potentially simple other options that may be better than the knowledge we're using that's 20 or 30 years old. What is the Bruce Lee principle, Frank?
The Bruce Lee principle is whenever you are looking at or taking in expert material or material you think is useful in some way, you want to absorb what is useful, discard what is useless, and add something that is uniquely your own. So it's simply a way of learning or a way of thinking about learning that I think, particularly in this area of personal finance, oftentimes people want to be all or nothing. They read something and it's like, okay, this is the answer. I'm going to do what this person says. That's all I'm going to do. And everything else is, I'm just going to push it away and not look at it or think about it. That's really not a good way to go through life at all, because you will find other sources of information. And if you really want to be evaluating it and growing and improving your life, Bruce Lee's principle is about life. It's not about investing in per se. It's simply about being able to absorb new information and incorporate it into what you already know without getting into this conflict of believing you need to either accept everything this person says or reject everything that person says. And I think that kind of black or white thinking is not helpful. Is where people get stuck sometimes, I think.
That's because of overwhelm. Investing, the financial services industry, they make you think it's so complicated. It's an alphabet soup. And when you start down the late starter path, I mean, it was overwhelming for me. I didn't think I could do it. I was like, this is like learning a foreign language. And it really is. And it doesn't take but 20% of the effort to get 80% of the benefit. And we may be splitting hairs a little bit here, and that's okay. And Jackie always argues with me that, Bill, all you focus is on portfolio theory and the numbers.
It's true, Bill.
No, he balances it sometimes. He will talk about some of the emotion and the psychology and all of that. So sometimes I'm probably a little too rough on him.
Well, you are, because we've talked to Carl Richards, and he's all about this stuff. We've talked to Daniel Crosby, go back to that episode, and we've talked to Dr. Brad Klontz. And mindset comes first. I readily admit that. Goals, mindset, consistency. Isn't there the hobgoblin thing or something there that you talk about? He has a lot of organizing principles on his podcast, and there's a lot of hilarity. But mindset first, or goals, mindset, math. And everything will work together in concert, just like your portfolio works in concert. And there are times for portfolio evolution. And retirement, I think, is one of those times to really consider it and realize that what got you there isn't necessarily going to keep you there. Right, Frank?
Yeah, I really think you should think of your personal finance no different than your health or your eating habits. You can learn how to cook, and first you learn how to fry an egg, and then maybe you learn how to make an omelet, and then maybe you learn how to make a quiche if you keep going. And the same thing with going to the gym and learning how to lift weights. Sure, you don't know what you're doing to begin with. That's true with everything, but you can't let yourself be afraid of like using the spatula or turning on the oven. Unfortunately, personal finance is filled with this fear stuff that if I touch the wrong button or buy the wrong thing, my money's going to go poof. The truth is a lot of this stuff is pretty malleable if you're reasonably careful about it. But I find that just being able to open an account and buy an ETF, that oftentimes is the sticking point. That once you get somebody past that, it's like, oh, I can open an account at Fidelity for $100 and I can buy $10 worth of GLDM or something like that. And you can do that on your phone now, believe it or not. Managing your investments isn't any more difficult today than ordering an Uber or ordering on Amazon or doing many other more complex things that everybody's doing on their phones today. There is just a mind block that thinking that it is more complicated than it is. It's not really complicated. It's unfamiliar is what it is. And you have to have enough courage to do something that is unfamiliar, because then it does become familiar. And you will find that managing a little portfolio or something like that, that once you become familiar with it, it's sort of like, oh, that's all it was. It wasn't.
Yeah.
In that regard, Frank, and you came up with a really nice thing with Mindy Jensen and Scott Trench, who are well revered in the financial independence community. And there's a couple of episodes, and we can link them in the show notes, where you take Mindy through, and she sets up a little brokerage account, puts $10,000 in it, and she buys 5 or 6 ETFs.
Oh, she wanted 8. She wanted more.
Oh, God.
Yeah, well, more diversification, right? And she gets to practice every month, doing a little bit of a drawdown and seeing if it works, seeing if this money survives using this approach. This is that curiosity principle and the simplicity principle, and have somebody hold your hand, get a mentor. Clicking the buttons are scary. She didn't have a brokerage account. She did it, and she was going to invest lump sum because she learned about lump sums versus dollar cost averaging, like $100,000. And she had her husband help her because it was physically hard to click.
A lot of people feel that way, right, Frank?
Yeah. What you mentioned here, Bill, and what I've kind of discovered in the past few months is that's actually a really good learning tool you can use these days, particularly a place like Fidelity where you can buy $1 worth of something. You can open an account really easy. You can do it on your phone. And so I think it's going to become more sort of the practice in whatever you're planning on doing. Maybe you should just go practice it with a little account where you put $1,000 in there or something, and then do a miniature version of it so you can see how to push the button, see how to put the money in, take it out, rebalance it. Because once you go through that with a small amount of money, it's no different with a larger amount of money, really.
And that's why it's so good when you're just starting out, just practice a little bit and you just get better and better. Same with anything as basic as budgeting and stuff like that. Our goal today in talking about this particular asset class was to hopefully help you have a better understanding of what it is, what it does, where it's appropriate, where it's not appropriate, and just shrink it down to size so it's not some big, scary thing that you don't understand. Frank, you do such a great job in breaking things down and making sure that people kind of understand it on a fundamental level. So this has been like a really great conversation, and we are always happy to have you back. Frank is in our Facebook group, so he's always happy to answer questions. And I don't know how you have the time, but you're all over the place.
I don't have a job.
Yeah. Well, I was about to say, you kind of have a job. You kind of have a job with Risk Parity Radio. So where can people find you besides our Catching Up to Fi Facebook group? And by the way, if you're not in there, come join us. We're just at Catching Up to Fi on Facebook. So where's the best place for people to find you?
The podcast has a website. It's called Risk Parity Radio. It's Parity, not ODY.
Okay.
Actually, you can probably own both those websites because both are appropriate.
And if you don't find me there in the Catching Up to Fi group, I'm also in the Choose FI group. I really don't do much other social media. My podcast is a retirement hobby, so there is not a lot of extraneous activity other than what's on the website there. And actually, one of my listeners helped me fix the website because it used to be the sore point of that everybody would laugh at all the time. Now it's up to date.
It's looking really nice, Frank. It's looking really nice. And if you love this dance and this conversation and what we talked about with Frank, please go visit his website, listen to his podcast, Parity Radio. We'll drop it in the show notes. But this has been delightful. Bill, I'll let you close this out.
Well, Frank, there's one episode of your podcast that I think is a good entry point to personal finance in general. You collaborate with Paul Merriman, and you had a Wizard of Oz theme that took people through the phases, the arc of growing in your personal knowledge. It's hilarious. It's a great place to start. You also have foundational episodes in your podcast so that you're not immediately overwhelmed and you understand how this is going to work. But what's that episode you did for Paul Merriman and his kids that I absolutely loved? And I would turn all of our audience to, if you're going to listen to one Frank podcast, so you know if it's the flavor you like, this is the one. Frank, which one's that?
I think it's 208. It could be 209.
We'll drop it in the show notes so that you guys can check it out.
Go to my website now. You can search the podcast. If you search Wizard of Oz, you'll find it. But yes, I did make that in response to Paul Merriman asking me if I had something for beginning investors. And I said, actually, I don't, but I can make something.
You fix that.
And so I did. But my podcast these days is mostly me just answering email. So email me through the podcast.
Love getting to know Frank. He can have a gruff exterior because he's used to cross-examining people, but he really has a soft, warm heart once you dig into it. I enjoy being his friend. His spirit animal is a hyena, and we just got back from South Africa, and he's hilarious. I encourage you all to try and interact with him. He's at Economy every year. Go to that conference. We're there. We want to meet you. So there's lots of ways to interact with him, and don't let him put you off. His humor is unusual.
Everything about me is a little bit unusual.
Everybody in our community is unique. And the best part about this journey is the community and the people you can learn from. So thank you, Frank, for joining us today and sharing your wisdom with us. It wasn't just about gold. It was about life. It was about mindset. It was about how to organize these things so you can live your best life. It's our finite resource. We get one chance. So join us again next week on Catching Up to Fi. Thanks, Frank.
You're welcome.
So, Bill, as you know, we cannot do this show without our amazing staff and the people that help us put this on. And our editor is Fritz Brizard. We love them, and they keep us going.
Yeah, Jackie. I mean, this show wouldn't have the quality it has without our folks, our peeps. And we'd also like to give you a few calls to action for the show. We love our community, and we hope you love us back. If you would like to support the show and our mission to help late starters, you can do that at Buy Me a Coffee, which is a platform that allows you to make a donation. The link is in the show notes and on the website.
Check out the show notes for resources mentioned in today's show. Also, head on over to our website at catchinguptofi.com and check out our vetted resources, partners, and affiliates for discounts and their services, because we love sharing great deals.
Please share the show with others and head on over to our Facebook community to help us grow. If you prefer video, head on over to YouTube and watch the show there. We hope you've enjoyed this episode of Catching Up to Fi. We would appreciate it if you could also leave us a 5-star review to help our message reach others.
And while we are financial educators that love to teach, remember that our content is for general education and information purposes only. We are not providing financial, legal, or tax advice. Always do your own research or consult a professional before making important decisions.
So, Jackie, we'll see our audience next time on Catching Up to Fi. Cheers.